Good afternoon, traders and investors. Will back here with another one, coming to with a Thursday market recap. Hopefully all of you had a very good day today. And in today's action, guys, well, the S&P has officially entered correction territory, coming down 10% off of its recent highs. The QQQs are now down about 14% from their recent highs. And even though we got a very decent piece of data this morning in terms of favorable producer inflation numbers, compounding off of the better than expected inflation report coming in yesterday for consumers, in spite of all of those positive data points, the market's still going down. And now I've largely been saying over the last few weeks, guys, that in spite of the recent decent data reports that we've been getting pretty much across the board in terms of the jobs reports not coming in too bad, and even the inflation reports now coming in not too bad, we know that the market is a forward-looking mechanism. And right now on the market's mind is front and center the tariffs by the Trump administration, of course, and what indeed is going to happen on April 2nd when the Trump administration announces the reciprocal tariffs against essentially the rest of the world in equal parts. And in today's video, guys, we're going to take a look at a few things together. Number one, of course, we are going to go over what happened today in terms of the SPY coming down into correction territory, and what can we possibly expect? What does history tell us in terms of the actual moves after the SPY enters a correction? Are there possibly deeper moves to the downside at hand, or what might we be seeing possibly a little bit of a relief rally coming in the next few weeks? Thereafter, we're going to take a look at our normal technical analysis and go through our major index rundown, take a look at the rotation, whether there is some, there isn't some, and thereafter as well, take a look at our big tech names and see, are the big tech names still at very attractive levels to buy, and which ones have I been buying as well? And to wrap it all off, we will take a look at a lot of stocks that I've been talking about since Saturday when I was presenting to you guys some of my favorite either swing trade ideas or long-term portfolio buys as well. So we'll take a brief look at those too. So today's video should be quite a fun one. Let's jump right into it, shall we? So moving into the SPY, down about 1.33%, entering correction territory, just over 10% top to bottom from the earlier portion of February. The QQQs as well, down today about 1.8, big tech selling off continuously at this point in time. The QQQs almost down 13.5% from their highs. And all across the board, as you can see, the indexes were largely down. No rotation to be had. However, we did start to see some rotation into these safe haven trades, namely gold and bonds, which we'll take a look at later on in the video. Into the sector rotation, well, lack thereof today, you can see that most of the damage was once again done by big tech. Apple leading to the downside 3.36, but no big tech names were doing pretty good. NVIDIA, as a matter of fact, was green for most of the day and then kind of tapered off towards the end of the afternoon. Financials also not having a good day, except for Uncle Warren. Berkshire up 1.68. Healthcare also not having the best day either. And the bottom half of the market, the so-called value rotation, did not get its rotation today either. Moving into the one-day relative, you will see that only basic materials and utilities were able to catch a bid and stay positive. To the downside, everything else led by communication services, which was largely responsible by Meta and Google to the downside. On the one-week relative, we still remain very painful at this point in time. Utilities and energy making it out alive, but everything else to the downside. And on a one-month relative performance, the declines simply continue. Healthcare is the loser that lost the least, and then to the downside, technology and consumer cyclical, with good reason. A lot of froth in technology names as of late, and consumer cyclical stands to argue when the tariffs are going to impact the consumer directly, and the odds of a recession ticking up ever so slightly stands to argue that that sector as well has not been performing too well. So before we get into more technicals, guys, let us dive right into the action of today, which was the correction territory on the S&P 500 as a whole, right? And that was due in part that even though this morning we got more than favorable producer numbers here in terms of inflation, month over month came in at 0 rather than a 0.3. That was a lot better than expected. Year over year, we came in at 3.2 instead of 3.3. And in terms of core, actually deflationary month over month, 0.1 to the downside instead of the 0.3 expectations, and 3.4 on core year over year. Everything was good in this report, and even initial jobless claims were less than the anticipated amount. It still was not enough. Yesterday's CPI as well was enough to bring up the markets, well, initially, then came down after tariff news before recovering in the afternoon. And even on the Tuesday session, we got a favorable JOLTS jobs and opening report, which showed that there are more jobs in the economy that were available. None of that was enough to calm the fears of the market in terms of the tariffs and in terms of the economic policies moving forward, at least for the next 30 days. There still should be a lot of uncertainty on the table. Now, in terms of corrections, guys, where do we currently stand after President Trump came in this morning? After the EU yesterday pretty much put tariffs 50% on American alcohol, namely whiskey. Well, President Trump came in this morning and said they are threatening a 200% tariff on alcohol and wine from the EU countries. That led us to the downside into correction territory, and the markets were not able to recover at any point during the day, just pretty much algorithmic selling, a lot of pressure to the downside as we remain currently in the SPY and the QQQs in oversold territory on both indexes. We've been there pretty much all week, but still not able to put in a local bottom and fracture some highs and get a relief rally going. So where do we stand, guys? When the SPY officially closes into correction territory, where do we stand? Well, here are a number of instances since 2008, your most recent roughly almost 17, 18 years of data worth at this point, right? After 1 week, well, the data is roughly mixed, but we do have an average of 1.6% to the upside after we could be seeing a relief rally. After 1 month, well, the data is still a little bit more mixed, right? Some years are good, some years are not so good. On the average, though, 1.7% to the decline. When we go on a longer term time frame, though, 3, 6 months, and 1 year, on an average standpoint, after 3 months, we're up about 2.1. There are some years, such as 2008, the actual outliers, that are a lot worse, of course, but keep in mind, in 2008, we had a lot of different factors than we had right now. You were talking about an entire financial collapse as the banks were heavily over-leveraged in arguably very speculative securities, right? Collateralized debt obligations, which is not the case right now. I'll remind you, we went over the bank earnings about a month ago at this time. The banks are very well capitalized right now and not even close to being over-leveraged overall. And if you look at the data just at a snapshot right now, GDP is still moving at a 2% forward rate in terms of the 2025 expectation. The jobs market is still plentiful in terms of jobs available. The unemployment rate is at historical lows, 4.1% right now. And inflation, as we've seen this week in 2 different reports, is trending now to the downside. So the economy right now is not falling off a cliff, contrary to people's expectations. If you were to look at the stock market alone, the data still shows that it is quite good. Now, can the data potentially be eroding in the next 3 to 6 months? Yes, but we are a long way away from what happened in 2008, probably not even close. However, the 2022 bear market is the closest thing that we have in terms of volatility and speed of the move to the downside at this point. I'll remind you, though, 2022 was a much different market as well. You were dealing with 7, 8, almost 9% inflation to the upside. The Federal Reserve was embarking on the fastest rate hiking cycle that they've done in the last 30 years. So it was a different market at this time, or rather at that time. Right now, we are dealing with the fears of uncertainty for the future without knowing how long the tariffs will be kept in place, nor how much the final amount of the tariffs are going to be. So the market, being a forward-looking mechanism, is trying to price in the most of that pain right away. But this is the closest that we can possibly get to what we're having right now, the speed of the decline at least, not the context of the decline for 2022, but the speed is definitely reminiscent of 2022. You can see 3 months after, though, we were still a bit negative on during 2022 after the corrections were occurring. But overall, if you look at all of them, average is still positive for the 3, 6, and then 1 year after, which goes to reiterate the point that I've been making. It's very tough, guys, to call a market bottom, whether it's the actual bottom or even local bottoms alike. The best we can do if we have a long-term portfolio mindset is to keep dollar cost averaging with every single paycheck into our favorite high conviction companies that have been around for 10, 15, 20 years, that have proven to us that they have resilient and sound business models that can make it through these types of corrections. And I've been pretty vocal about the ones that I've been buying, but we will recap those companies as well at the end of the video. So there's the snapshot as to where we might be expecting to be at some point over the next week, month, 3 months, 6 months, and 1 year, respectively. Still a fantastic buying opportunity across a host of different metrics, right? Now, in terms of those metrics, when we dive into the S&P, I will remind you in terms of the market breadth, right? Where do we stand right now? Well, we are still at extreme fear. If we take a look at the CNN Fear and Greed Index, this one should have tapered back again today. Right now, we're sitting at a extreme fear read of 15. Momentum, extreme fear. Stock price strength, net new 52-week highs and lows on the New York Stock Exchange. Well, of course, that's going to be an extreme fear because there is a lack of overall breadth in the market. A lot of things hitting new 52-week lows by the day. At this point as well, stock market breadth is not too hot. It is currently still at extreme fear, one of the lowest reads that we've had pretty much in the last 12 months of data. And that can be displayed when you look at the percentage of stocks above their 20-day moving average, now down to a low point of 16.94%. Historically, this has always been fantastic opportunities to buy the dip. You can go back on this chart all the way to 2002. And every single time we clip into this low zone here is a great time to be adding to your long-term portfolios. I know that right now it feels like you're basically throwing money into the fireplace, and that is completely normal, guys. But that is the nature of buying these dips. A lot of people were telling me that they were hoping for these dips all throughout last year, that the market was overvalued. They wanted a correction to get more manageable valuations. Well, now you have your chance, but do not spend your money all at one single time. Buy the dip progressively as we fall through these levels over the next 30, 60, 90 days, and you will end up at the end of the day with a lot more shares than you previously had, and you'll be able to carry those shares into the next 5, 10, 15 years as the companies that you're invested in continue to do exactly what they have been doing for the last 5, 10, 15, 20 years, which is expanding EPS, expanding revenue, expanding their free cash flows, and growing overall. You want to be focusing on companies that have high competitive advantages, large moats, which means that they have low competition and high barriers of entry. That is the nature of a high quality company. So that's percentage of stocks below their 20-day moving average, below their 50-day moving average. Same concept, a low percentile of 22% of stocks only above their 50-day. Historically, has it been a good time to start buying the dip? Absolutely, and you can go all the way back to 2002 to find that proof. And percentage of stocks above their 200-day moving average, the longer-term moving average, is at a 32.5 read. Now, if you go back in the historical context of this one as well, you can see that if I just move this one, this bar down to just encompass the general area of where we're in, has it been a great time to buy the dip? Yes, and that since 2002. Can it go lower? Absolutely. But that's why this can be a very good starting point to start to buy these companies. And if you have regular income, you'll be able to buy them over the next 3 to 6 months, or however long this correction actually lasts. Because, of course, myself and everybody else included do not have crystal balls. The volatility can last. And if you ask me my gut feeling or my best guesstimate, I would say that the volatility is probably going to last through at least the first 2 weeks of April. Why? Well, it's because it's very simple. The market right now is not even pushing to the upside after good economic releases. So at this point, the market wants one thing and one thing only. It wants more clarity on the tariffs, the duration, the negotiation tactics, how long they will be, obviously I just said the duration, put on, and what will be the final amount. And until the Trump administration removes these tariffs, sits down at the table, negotiates with partners, and they come to bilateral agreements, and everybody starts tapering back on the tariffs, the markets will not find their true bottom, in my opinion, especially not with the April 2nd date looming, at which the point comes through the reciprocal tariffs against everything else. Then we have to wait for the retaliation phase by other countries, then the negotiation phase, and then, of course, the final outcomes out of all of that. So if we're looking for a true market bottom, I would potentially say that it's going to maybe be by the end of maybe April or May in terms of that, in terms of the economic damage that could be resulting from these policies. That will be felt in a little bit longer, talking about the next 3 to 6 months. So if you ask me for my best guesstimate for how these markets could possibly behave maybe over the next few months, well, possibly March. Well, March is already going to be negative. April possibly going to start negative as well. If we get some relief rallies after some tensions, yes. But then we might get some hard data, guys, to where we might just curl over because the data is unraveling. That could also correspond with a Fed pivot where the Fed starts decreasing rates more rapidly. And after these two massive legs of decline, potentially reminiscent of either 2022 or the last time something like this happened, which was 2018, something like this, two big legs down on the monthly time frame, that is when you might find it. But what I am saying is there might be a little bit more volatility, a little bit more pain through the month of March, maybe through the month of April, and then we might get a little bit of a relief rally as everything starts to get finally priced in. Now, that is contrary to what the seasonality might say in terms of historical seasonality. This is a bit of an odd year because, of course, we have a lot of things currently on the table in terms of geopolitics, but usually the markets tend to bottom at the midpoint of the month of March before embarking on an April and May and June rally. I don't know if that's going to be the case this time, guys, because we have that tariff date looming on April the 2nd, but we will see. I'm just presenting the data. This is the seasonality. There are also some people that say there's a theory circulating around. I'll let you guys be the judges as to how much weight you want to put to this theory. But there's a theory going around right now from a few analysts on Wall Street that is the White House trying to engineer a recession? This Wall Street Pro explains the vision. President Donald Trump and his administration need an engineered recession to cause a growth slowdown and disinflation that will translate into Fed rate cuts and a meaningfully weaker US dollar for the past phase of his economic agenda. One of you, my subscribers, also said that in one of your comments, and I said that this was a popular theory circulating around for the last week. Well, now it's actually hitting the press, so I figured that I should present it to you guys, especially if it's circulating around Wall Street as well. It stands to argue Trump ran on the fact that he wanted to bring inflation down quickly and also wanted to bring interest rates down quickly, right? So this is the premise of the theory. As I said, it's up to you guys to judge whether or not that's going to be the case. I will remain apolitical in terms of what the Trump administration wants to do as a result of these tariffs. They've been vocal about saying that it's for the United States to get their fair share, but is there a 4D chess hidden agenda behind this, which corresponds to this Wall Street theory? Well, at this point, it's just a theory. We can possibly not know at this point, right? The idea is that Fed rate cuts and supply side stimulus from tax cuts, because we know he will be doing tax cuts and deregulation to corporate America, will then be able to build up the economy without the need for government spending. So that is your theory. Do with that what you will. But all of these things combined can lead to extended volatility in the markets in terms of price action control, but we still remain on a daily oversold basis on the SPY, even on the futures, a little bit more oversold on the futures. As a matter of fact, the last time we were this oversold on the S&P 500 futures was 2022, when we got the bottom of the first leg of downside before a relief rally, and then we got another leg of downside. So can we be approaching, as I've been saying in the most recent few videos, can we be approaching a volume climax right now, possibly into oversold conditions? Oops, let me just put the volume on this one as well, so we can see the volume climax over the last few days. Volume climax, right? Big volume selling pressure. Can we be seeing a little bit of a relief bounce? It is very possible at this point, and I would not be surprised, but keep in mind as well, any bounce at this point is going to be for a lower high, and the lower high is way up here, guys, all the way up there. Why is it all the way up there and it's not one of these candles? No new highs. Lower high on the day, 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 all the day, lower high, lower high, lower high. Your actual lower high, when we got a move up from a prior day, is all the way up here, 597.16. It is a long way away at this point, guys. So the V shape is highly unlikely. The most likely result is going to be a bounce, lower high, and then depending on the size of the bounce, the bulls can either confirm a new daily uptrend, get more of a weekly bounce underway, something like this, but the result will also on the weekly be looking for a lower high. Keep in mind the resistance range is going to be 585 down to roughly 577, something like this, bounce like this, and then retest. Then it'll be up to the bulls to prove it to them. Can they get the daily uptrend back and go for more? Or if the bounce is too shallow, will we just roll over? We are desperately trying to hold on to this weekly support level. I will not close it red until the weekly candle closes below here. Still 1 day of trading left to do that. That's the resistance all the way back from the month of August before this correction started. So we'll see if the bulls are able to put in a green day tomorrow, but the market's definitely not looking too good. Any short-term bounces will just be that. You can call it a dead cat bounce. You can call it a search for a lower high, but it is definitely going to be a bounce until we get a confirmed daily uptrend. And that is the analysis for the SPY. Moving on to the Qs right now. So taking a look at the QQQs, down about 1.8% on the day. Coming very dangerously low to flushing the lows of Monday and Tuesday, but not quite getting it just yet. Volume climax was on those 2 days. We do have now diminishing volume into oversold conditions, which are also criteria that usually do translate to a bounce. Your lower high is all the way up here at 512.88. Any bounce is going to be looking for a lower high, and then it's up to the bulls to prove it to us. Can they then use this support area, which we have not lost just yet, 482 down to about 468, to kind of recapture a lot of this damage? Yes, but resistance stays put at 500 up to 492. Then it's up to them to prove to us, can they get the daily uptrend? Or will we simply roll over towards equal lows or lower lows, same as we had in 2022? Weekly, large engulfing move as well. As you can see, not close to weekly oversold. However, any relief rally will just be looking for a lower high into heavy resistance. And then it's up to the bulls to say, can we get the weekly uptrend back? Or are we just going to go for more sell-off action into the month of April, which would lead you into further monthly consolidation? The next area, if ever we do not do that and just flush straight through, is down to about 448, roughly 450 if you want to call it psychological. These guys down here, right? 450 down to about 430, which is this resistance high range from all the way back in March of 2024. Moving on to financials right now, financials continuing their declines as well into now daily oversold conditions. Not yet at the peaks of volume that we saw just 5 trading sessions ago, but very close at this point, right? Daily downtrend is still clearly underway, and any bounce out of the support range, 48.32 to 46.77, we are looking for a lower high. Then depending on the size of the bounce, for the size of the bounce, always use the fibs, guys. If you can get up to 50% bounce or better, gives the bulls the best chance of creating a new daily uptrend. Anything under that really gives the bears the best odds of either equal lows or the rollover lows. If we cannot even find any support and just drop from here, I'll remind you the next zone of support, if you crack this one, is down to 46.11 to about 45.38. Moving on to healthcare right now. Healthcare giving up all their gains at this point in time. Daily downtrend, big rollover on healthcare. So unfortunately, daily downtrend is also synonymous with the weekly rollover timeframes as well. And now we are dangerously close to cutting those weekly lows. Lose those, and unfortunately, you do set up for a loss of the weekly uptrend and a retest of support, which is 140 all the way down to roughly 128. So all the way down back in the gulag, at which point we spent 2 years of time back from 2021 through 2023. But notice through 2022, when all of the market was falling apart, healthcare was largely resilient. Can we be seeing maybe the same time this time around if we have an initial drop and then just hover around this range? Highly likely, but we'll take this one day at a time. Moving on to semiconductors right now. Well, NVIDIA was kind of holding up the semiconductor army today, but they couldn't get it done that much. Intel popping 15% after they swapped their CEO for a former board member. So there's a lot of bullishness around that. Call it the Brian Nichols effect. Same thing we saw when Brian Nichols went from Chipotle to Starbucks. So new CEO news, especially one in which Wall Street has confidence, can lead to some decent rallies. But I mean, Intel, guys, is still beholden to this massive range, right? For big resistance, $25 to $29. I think it's going to be a long time before they get through that, especially in these market conditions, right? If the SPY and QQQ and the rest of the markets just keep plummeting, you guys really think Intel's going to make it through roughly at this point now, a 3/4, so 9 months worth of resistance? Debatable, right? But in terms of SMH, to come back to this one, we did have a nice little bounce, but the lower high is still set all the way back here. 235 is your lower high. So until we can get a very nice bounce, which is not right now, because if you put the fibs on this, right, very shallow bounce, only a 50% bounce, not even closing a candle there. So this is really 50-50. We start rolling up, we start rolling down, the likelihood of retesting the lows is very probable. If you get 1 or 2 more days worth of bounce, give me a 618 or a 782 bounce, then the recapture possibility of the support range 218 up to 232 is equally likely, and we may just be able to close a weekly candle still within the zone. That's why I have not moved this box into red territory, because we are, technically speaking, still closing within it, at least for now. We will see how the weekly candle closes tomorrow, but right now, weekly downtrend, if we just keep going, the next line of defense is 199.50. Call it psychological 200. Moving down to the Russell right now, the Russell also plummeting. Lower lows on the Russell today, so very unfortunate for them. Another daily downtrend leg of selling, right? Lower high, move down, lower high, move down. So now the lower highs are well within striking distance for the bulls. If you do have a nice bounce, 203.64 is your lower high. However, daily bears are in control all the way down into support. 200 down to about 190 is the next support range for the bulls. It looks like this. A very big one, guys. Support, big resistance. Now support a number of times, 200 weekly EMA. So this is a very big level for the bulls right now at this point in time. From the highs set in November, guys, the Russell is now down almost into bear market territory. Bear market is 20% plus off of recent highs, and the Russell is almost there. So we will see. With daily oversold conditions right now at a 23 on the RSI, can the bulls get together a bounce, reset a daily uptrend? Well, possibly, but they would be running into resistance quite quickly. 208 down up to roughly 217, and that would just be looking for a lower high on the weekly. Then it's up to them to reset the weekly time frame, or if the bounce is too shallow, you're going to revisit the lows or possibly even flush, and that would lead us down all the way down into these guys down here, the lower 180. So I'm not going to predict where the market's going to go. Maybe we'll just follow the price action, but one area that I definitely do not want to be in right now, when the market is having growth scares is in growth stocks, especially unprofitable growth stocks, a lot of them. And now lastly, the Dow Jones. The Dow Jones currently sitting right now down 1.3%. Big lower low on the Dow Jones right now. Daily oversold conditions. We have not had a 27 RSI on the Dow Jones for a very long time. Matter of fact, the last time was 2023. And prior to that, a few separate instances in the big bear market, that was 2022. But even in bear markets, guys, the rallies can really rip your face off. Look at all these bear market rallies, 9, 6, 7, 8, 9% rallies before lower lows, right? So the markets can be very, very, very volatile, which is why I say when the bounce is going to come, it's probably going to be a very volatile bounce. But unless we solve many of these issues that I've been describing from the past week, unless we take all of them off the table, the bounces will get undone every time some of these news items are going to hit the tape. So keep that in mind for the Dow Jones, currently working into the last line of defense, which is 40,500, into oversold conditions. If you do get a bounce, I'll remind you, the lower highs are currently set right now at about 43,100. Now, any bounce just going to be looking for a lower high. And at this point in time, unfortunately, unless we have an incredible bounce tomorrow, right? This resistance box, I'll put it red for now, and that's going to be our overhead resistance that the bulls will need to deal with if we get a bounce thereafter into it. 42.5 down to about 41.9 on the monthly time frames. We'll take a look at the monthly time frames tomorrow, but not looking too good, right? Monthly downtrend rollover right now. The next stop, if you flush this big location, is all the way down here, 38,400. And unfortunately, that would be a top to bottom correction of 14% on the Dow. The peak of 2022 went all the way to about 22%. So we'd be 3/4 of the way there if we get into it over the next 30 to 60 days. That is everything for your major market rundown. Now, if we take a look at the yields, well, yields are finally starting to catch a bid. I've been talking about this the last few days, right? How there was no recession bid in the form of bonds. Well, today you finally got one, and I was able to buy the lows that I've been looking for on these bonds to catch that bid. Moving on to the TLT, or the 10 and 20-year yields, rather, you're starting to see the daily rollover, right? Equal highs, possibly into a rollover, could be a pattern to watch out for because we know it was a weekly uptrend, big engulfing move. If they set the weekly lower highs into lower lows, weekly downtrend is underway, and this would be fulfilling the prophecy of the head and shoulders. On the 20-year yields, you can largely see the same pattern you're looking for. The engulfing move by the bears, the lower highs, maybe into the rollover, would be a head and shoulders pattern. And on the TLT, which is the inverse, you kind of be looking for the same thing, right? Looking for the inverse head and shoulders, possibly for expansion into the next area, 94 up to about $96. That's going to be the next target for the bulls, but they're not looking too bad, right? Daily downtrend, nice engulfing candle today, right? Well, a very powerful momentum candle right now. Been waiting for this one, the pullback into the 90.89 zone, which I was telling you guys. I did buy some January 2027 leaps. I went with the $80 calls. All the way down here is the strike for about $13 for 2027, because I think this trade is a win-win. If, right, the economy slows down and the Fed is forced to pivot to more rapid rate cuts, this trade will go up very fast. If the Fed does not pivot and the economy is fine, but inflation continues its downward trend, this one will also be a winning trade, at least over the next 2-year time frame that I've chosen for it specifically. Moving into gold right now, gold finally breaking out. I was telling you guys about this technical zone of accumulation, possibly looking into a daily upside break. Why do we have that bullish leaning bias? Well, because we were always in a monthly uptrend. We were always in a weekly uptrend as well, just looking for higher lows. Nice to see the bulls actually crack through that. Maybe going all the way to 3,000 could be interesting. But if you ask me my opinion, guys, you are pretty late, right? Gold usually doesn't stand up too well in the face of either economic recessions or bear markets overall. And the proof is really in the chart, right? You go back to the bear market of 2022, you can see that although gold did pop initially into that bear market when stocks were selling off, eventually it too, faced some bearish action down about 20+% from the highs. And then if you go back all the way to 2008, the last great financial recession overall, well, from the top to the bottom, same thing. Gold started rallying early into the recessionary conditions, and then top to bottom declines on gold was down 32%. So just be careful on the gold trade. It's not as protective as you may think. In my opinion, if I had to choose between gold or the bonds for a kind of a recession hedge, it would have to be the bonds in my humble opinion. I think they're presenting better value for traders and investors alike. Now, moving into Bitcoin, Bitcoin's still doing a whole bunch of nothing right now. The bears are still in full control of this chart. Daily downtrend, lower highs are most likely set at this point in time, unless we can find some sort of miraculous rally into tomorrow. And even if we do, into big resistance, guys, right? This was huge support for the bulls. You can see it reacting as resistance right now. The 200 EMA is also above us, 85,000. So 88 up to about 91, big resistance. We will see. It's all up to the bulls, right? Can they get the daily uptrend back? And then can they smash through this resistance and give us a chance at recapturing the weekly? Well, if the SPY and QQQ are not cooperating and none of the risk assets are cooperating, Bitcoin is not going to cooperate either. If we do flush a little bit further and the bears just roll this one over into a lower high, lower low pattern, I think we are heading all the way down below. Should be clear as day. Prior resistance going to be newfound support, 74,000 to about 67. I would be a big fan of picking up some Bitcoin in this lower area if we do drop down there. And the rest of crypto, well, stands to argue, guys. If Bitcoin cannot even keep it up, the altcoins are not going to going anywhere. So we need to bid these small, and I would be using Bitcoin's levels to start bidding the altcoins because the altcoins are going to move in a volatile fashion either way. Moving into Apple right now. So Apple, one of the biggest loss leaders currently on the markets right now, at least in the last 4 days of action. Apple was doing a great job of holding up its gains, and then it joined Team Bear, unfortunately, over the last few days. So daily downtrend is very well pronounced right now. Apple finding itself into daily oversold conditions. You'll notice a parallel amongst all of these big tech names. They are all in daily oversold conditions. That can only last so long before we start getting some bounces, but even if Apple does get a bounce, we will have to deal with big overhead resistance. 225 down to about 215 right now is that overhead resistance on Apple. Keep that in mind. And in terms of the weekly, well, it's a sweeping weekly downtrend flushing through the zone right now. The next destination for Apple is all the way down here, 200 to about 195. And it would not be surprising if it joins its tech peers in a 20+% correction. I'm not buying Apple, at least not before we flush that $200 range, because Apple right now still is one of the most expensive names in all of big tech. Currently, well, not currently, but 5% lower right now. The PEG ratio should be around a 2.7, 30 price to earnings on a forward basis, struggling with expanding iPhone revenue and just slow revenue growth overall. So I will not be touching Apple until I at least see some better pricing, which for me really starts within the $200 and $180 ranges. We will see if we can actually get some of those lows in the most recent, or rather in the future upcoming weeks. Moving into AMD right now, down about 2.66%. AMD, though, has been dropping less than the rest of the pack. You can see here in the last 2 weeks of trading, we really haven't flushed the absolute lows, which stand at about $95. That being said, the bulls are also not really mustering up any form of a rally. For that, you would really need to see a break of 103.28 to the upside. That would be a new daily uptrend, and then we could talk about the bulls' capacity to recapture some of this weekly downtrending, pattern or channel, rather, right? Sweeping weekly downtrend overall, clear as day. So the bulls still trying to find a base of support. However, if we close below 95 tomorrow, it's not going to look the best. The next big line of defense is down here, $83, guys. So it is a long way down for AMD after that. I will consider buying some shares as we go into the lower $90 to $80 range, as the valuation right now is getting a bit too good to pass up if you are a fan of AMD. The PEG ratio right now is probably sitting at a 0.5. We did it at 108. Right now, it's probably sitting at a 0.5. Fundamentals of the business are looking very good. These are the types of deals that I want to find in an overall bearish environment, right? Very nice expansion of EPS, very nice expansion of revenue, and that is independent of the overall status of the consumer. Most of that is going to be for data center spend, and a lot of those contracts are still now already locked in. Moving on to Amazon currently. So Amazon down another 2.51%. Now this, in my opinion, guys, is going to be probably one of the best buys of the entire market during the correction phase. Why? Well, because Amazon's fundamentals are fantastic. Average analyst price target still sits above 200. The EPS expansion is going to be fantastic over the next 4 years as they expand the e-commerce business, they expand the AWS business, Amazon Prime Video, their advertising business, the pharmaceutical business, and all other business components that Amazon owns. Revenue is also going to be expanding very, very fast. Now going to surpass Walmart as the company with the most amount of revenue in the entire globe right now at this current stage in 2025. But the damage by the bears is being done for sure. Amazon currently off its highs by about 22% at this point in time. Daily downtrend clear as day right now. The most recent lower highs are the highs of yesterday. So right now, 202, right where the 200-day EMA sits right now. If you can break this on a nice break to the upside, that will be a new daily uptrend. But we can talk about the bulls' capacity. How much can they recapture of this weekly move, possibly for a bear market rally, because Amazon being down over 20% is officially in a bear market of its own. That being said, if we cannot break that to the upside and we just continue flushing, Downside support remains set at 185, which is a fantastic buy level through here for a first buy nibble on Amazon. And in the event we continue flushing, maybe through the month of April as well, I think final destination for this stock is 175 down to about 155. That would be fantastic value for this company. That would be a sell-off of 27 to 32%. If you cannot buy Amazon, guys, when it's down 25+%, you might never be able to buy Amazon sufficiently, right? A lot of you have been waiting for a discount. Amazon's now giving you a discount. So even at a 1.49 peg at 190 right now, I think it's an amazing opportunity if you have a long-term horizon in front of you. Moving on to Google, Google also down 2.53% as the declines on Google simply continue. The bears are in full control of this chart as well. Google as well is in currently bear market territory, down off of its highs more than 20% after the close. The support range stays put at the bottom of 163. Still in it right now, 174 to 163 is this overall zone. If you flush this zone over the next few weeks, coming right down there, guys, to the bottom end of this range, which is 153 down to 144. Now, even here, this is a fantastic opportunity if you like Google as a company to be picking up some shares. The valuation is a 1.23 forward peg, 18.5 forward price to earnings. That is extremely cheap for a fast-growing tech company with amazing net margins and amazing free cash flow as well. So just keep that in mind. If you want the bears to come alive, if you want the bulls to come alive, you need to get that daily uptrend going and start reversing some of this weekly damage and then recapture the top end of the support zone, 175. Moving on to Meta. Meta also right now in a bear market of its own. Top to bottom declines on Meta right now at the close. We're roughly still 20.31% and still in a very large sweeping daily downtrend overall. So your lower highs stay put at the highs right now of yesterday, 632, which was an area of resistance that I was telling you guys to be a little bit cautious of. And now we're right back into support, 598, call it 600 psychological down to the 200 EMA, which is 575. Contrary to a lot of stocks out there, right? Now, Meta has not fractured their 200 EMA. Apple below the 200 EMA. Amazon below the 200 EMA. Google, which you just looked at, below the 200 EMA. When we move down, you'll see that Meta is one of the only ones that has not broken it. Is it going to join its sector peers in those declines? Well, the likelihood is highly probable at this current time. If not tomorrow, if not next week, maybe throughout the second leg of the correction, if it does indeed happen. That being said, the valuation of Meta right now is sitting at a 1.9, not the cheapest on the street, that is for sure. But when the company has fantastic free cash flow and outstanding net margins and has been doing some good cost control, I think Meta is starting to come into bid territory right now. Fantastic EPS expansion in the next 4 years, fantastic revenue expansion for the next 4 years as well. You can make an argument that if we go into an economic recession, yes, companies may pull back on their advertising spend, but is this a good first area to buy Meta? Yes. The actual heavier area to buy Meta, in my opinion, is down here at about $530 down to about $500. That would be a top to bottom decline on Meta of roughly 27 to 30%. So you've noticed a common theme here. I'm a big fan of starting to bid companies 20% through their all-time highs, and then I increase the size of those buys as we approach 30% off the highs, and we approach more deeper levels of monthly consolidation overall. Moving on to Microsoft. Microsoft also down today, 1.17%. The market's getting a nice little bounce in the after hours right now in terms of the futures. Just probably some after hours action. Not too sure if those are going to translate into tomorrow. That's happened a few times so far. Let's get back into the TA, shall we? Moving into daily downtrend territory right now. The lower highs arguably not set because we did not break the highs of Monday just yet. Still lower lows every single day. The lower highs are still set 402. If we want to see a bounce from the support range, 378 down to 364, you need to see a nice 60-70% bounce. Then we can talk about the ability to recapture the uptrend. As of right now, I'm on the verge of closing this box red. If we close the weekly candle below here, there's a high probability of us doing that. So in the event of a bounce, just looking for a weekly lower high into big resistance. This was a year's worth of support. So it's going to take a lot of power to get through that in one clean shot. The best chance is probably a two-step move if they can get it done at all. If not, we're probably coming right back down here, lower end of which is about 365. Microsoft, a fantastic company right now at 380, a 1.99 peg, a forward price to earnings of 29 right now. You usually do not get to see Microsoft below a 30 forward price to earnings. The company is just too consistent in terms of its fundamentals. Fantastic EPS expansion. It never really misses, and fantastic revenue expansion as well. Great opportunity to be adding one of the best companies in the world to your long-term portfolio. Just keep dollar cost averaging. If we don't know when the bottom is coming with certainty, the best thing we can do is acquire more shares. The name of the game at this current time is ownership. You want to make it out of this correction with more shares than when you actually started this correction, right? Everybody's been wanting the dip. Now, don't tell me you're nervous about buying the dip, right? It's just pace yourselves, right? You can't be asking for a dip, and then when the dip comes, you just sit in cash and think you'll time the absolute bottom. It's not that easy, guys, right? Netflix down about 3.21% today as well. Still in the context of weekly consolidation, but not losing a weekly uptrend as well as its sector peers have, right? Now, the lower end of support down here is roughly 825. We are not there yet, but you can see how powerful this resistance area was, which I was telling you guys about yesterday. Daily downtrend into resistance, 935 down to about 900. We're now breaking down below. We will see if Netflix continues its declines. The next area we're going into, 825 down to 800. 800 is the 200-day EMA. Similar to Meta, Netflix just ran up too much, right? That's why it's so far away from its 200. If we do come some declines, that would also be the 12-monthly EMA, an area that Netflix has respected many times over its most recent bull rally of the last 2 years. Fantastic opportunity if it does come down there. 800 down to about 700 is the area that I would consider adding to my Netflix position. Moving into NVIDIA right now, down about 0.14%, but NVIDIA was up most of the day. Most of the day, this stock was green. And then unfortunately, towards the tail end of the day, we started erasing those gains. So right now, the bulls are trying for a bounce. And so far, the size of the bounce is not too bad, but the lower high is all the way up here, 135. Look at the size of the move that you need to recapture some of that bounce. On the fibs, this is literally a 38.2% bounce. If we start losing levels from here, a retest of the lows is highly likely. If you start bouncing to 50%, even 618%, the start of this big red resistance box, 125 to 133, that is when the bulls have a better chance at resetting into a daily uptrend and attacking that resistance range. So far, below us sits support again, 111 down to 102. In the lower 100s, guys, fantastic opportunity for NVIDIA. If you like this company, at 115, it is a 1.1 peg. So down below at 105, it becomes a 1 peg. You're paying almost nothing for the growth of this company over the next few years. Looking quite good on NVIDIA. I will be adding some shares if we come down into that location. Now, moving on to Tesla. Tesla down about 3% overall on the day today. Tesla has just not been one of the beneficiaries of the most recent few weeks. That's to say for sure, right? So Tesla now down 3% on the day, right below, right at 240 rather. As I was saying, the bears in full control of this daily downtrend. The bounce of the last few days was okay, but it just still remains a bounce. Lower highs are possibly set right now at about 251. If we keep moving back down, support stays put 220 all the way down to roughly 200. I'll remind you, as a Tesla shareholder myself, I don't have as many shares as I did because I bought this company all the way back. Guys, I bought this company all the way back here, right? And I was selling. I have a decent sized position remaining, but nowhere close to what I started with. That being said, as a Tesla shareholder at 235, the stock is still a 4.14 peg. And I'm a bit nervous for their earnings that are coming up in about a month and a half at this point. We know that Tesla sales have been down pretty much across the board. So I'm not too sure how they're going to salvage these upcoming earnings. So I'll be highly careful moving into this earnings season for, Tesla specifically. That being said, if the bulls want to recapture, you really need to give me a bigger move than that, right? The lower highs right now, 302.50. If you can give me at least a 50 to 60% bounce, which would be 260 up to about 275, then we can talk about the capacity to recapture the daily uptrend. But keep in mind, those levels are into resistance 260 up to about $300. And it's a big one, guys. It's all of these guys, right? Support, resistance, right? Resistance for these guys, resistance for a while, resistance. Then you got the blast through, also known as the fair value gap that was created after earnings. And now this area will be resistance once more as the bulls try to possibly take back some of these moves. But if you just look at where the lower high is on the weekly, 434. If you get rejected here, guys, the likelihood of retesting the lows becomes very high. 200 down to about 221 down to about 190 is that support range below us. Moving on to Palantir. Palantir down at 4.82%. And even Palantir, guys, at $78, still very high in terms of valuation. Valuation matters now once again. 144 forward price to earnings. 5.15 PEG ratio. That is crazy high still. And a 29.5 price to sales. It is extremely high. And I'm telling you guys that as a Palantir shareholder with my shares down at about $11, $12 average cost. That being said, Palantir is doing a good job of defending its support zone. 83 down to 77 is that range. The bears kind of running out of juice a little bit, but we'll see what happens tomorrow, right? In the event that we flush, we're coming right back down for another leg of selling, 72.50 down to about 65, 62. If you come down here, there might be an opportunity if the volatility is high enough to write some short puts, 50, maybe even like mid 40s, and that will be a much more manageable level for Palantir. I'm not saying it's going down there. I'm just saying if it comes down here, there's a trade opportunity to write some put options to acquire some shares, maybe from 50 to 40, which will be a much more manageable level. But overall, the bulls holding up not too bad. They never lost the weekly uptrend, right? Just trying to find a weekly higher low, anything above 64, looking for a higher low. For possible best case scenario, a tightening range. Palantir is definitely not going to go back to crazy all-time highs, guys, in the context of these markets. The best chance the bulls have is that a tightening range grow into this valuation, because this is a large engulfing move, right? To the downside. Put the fibs on this, 78% retracement. You usually do not get a V-shaped recovery after a 78% retracement. It's either a multi-stage process or at best a two-stage process, but the V-shape is somewhat unlikely. If anything, you might just result in a lower high, and then we'll see if the bulls can protect for a lower low or if we roll over on this name as well. And now lastly, SOFI down about 4.45% overall, down into roughly the mid $11 range. Now, this has been a range that I've been targeting, guys, roughly about to 1167 down to about 950. Heavy area. That's the IPO price pretty much. And you have all this resistance, which should now be support. The longer term moving averages on the monthly are there as well. I'm a big fan. If you're a fan of SOFI as well, I'm a very big fan of adding from here, the 11 down to about 950 range. Very decent from 52-week highs. This is a sell-off of now 40%, guys. So it's a great opportunity to be adding some SOFI. The valuation overall, guys, is quite manageable right now in terms of SOFI. Only a $12.5 billion market cap. And look how much money this company is going to be bringing in next year, right? In terms of a digital bank. Next year, the company's going to bring in 3.22. So you're sitting at about 4-to-1 price to sales, which is quite manageable, especially considering that you're also expanding EPS at a very fast rate and expanding profitability. Net profit margins are doing wonders in terms of expansion as of recently too. So although there could be more pain on SOFI, I'm a big fan of dollar cost averaging into some shares that you might want to keep for the next few years. And that is all my take on SOFI in the markets right now. Now, in terms of the plays, you know what? As a matter of fact, we'll keep this video shorter because there's one day left of trading. And tomorrow, when we do the Big Friday recap, I'll go through these TA technicals for our usual names quickly. And then I'll spend a bit more time, since it's going to be the weekend, on a lot of other names that I'm looking at as well, kind of exactly like I did last Saturday. However, before I end the video, I wanted to leave you with one video which, regardless of which side of the political spectrum you are in, regardless of how you're feeling in the markets, it's a pretty good video. So I'll leave you with the comic relief of the day, because I know a lot of people might be stressed, a lot of people might be anxious, a lot of people might have lost a lot of money recently. But if we have a long-term time horizon, I think it's a good opportunity to buy. As I always say, guys, sometimes it feels as if you're shoveling money into the fireplace. But when you're investing in some of these companies and others that I'll show you tomorrow that have expanding fundamentals, toll booth businesses, as Warren Buffett calls them, that operate in any business environment, whether an economic downturn, a bull market, whatever, if you're buying them during bear markets and corrections in an expansionary bull market thereafter, you're going to be extremely happy with the buys that you're making today. I know it does not feel like it right now, but in the future, right? If you look at these charts, all of these charts, you must have always told yourself, especially if you're new to the markets, right? Oh, I wish I would have been able to buy during COVID. I wish I would have been able to buy during 2018. I wish I'd have been able to buy during 2022. Well, now is your chance to start buying when nobody wants to buy and accumulate some shares. And I'll see you on the other side, because at the end of the day, the markets always do recover. It may take a week, it may take a month, it may take a few months, but eventually when the SPY comes back and we get rid of all the Trump tariff narratives and the economic downturn narratives, and the Fed starts cutting interest rates, and the overall, not only US economy, but worldwide economy goes back into an expansionary phase, which will come, they always do, right? The economy moves in cycles. You'll be very happy when the SPY is trading up here and all these tech companies are beyond their all-time highs. You'll be very happy that you tried to buy the dips, practice your psychology, right? Of buying when the whole world seems to be on fire, when nobody wants to buy, when everybody's saying the market's going to go to zero, right? You want to practice good discipline in buying. Don't take it from me. Take it from legacy investors who have come before me, Peter Lynch, Warren Buffett, or whoever your favorite investors are. It's nothing new, guys. I'm not rewriting the wheel. We're just using the exact same playbook. Timing the market for long-term portfolios is a very difficult thing to do. The best thing we can do is every week, every 2 weeks, every month, depending when you get your paycheck, save 10, 15, 20% of that and invest it into either your favorite ETFs or your favorite individual companies. Your future self will definitely thank you. But for now, some comic relief, shall we? So let's go. All right, this is what came out the other day with the Tesla and Trump highlights.
Tesla. Going on now at the White House Tesla Auto Mall. It's the biggest sale of the year.
Very safe, it's very strong, heavy. It's all steel, stainless steel.
Come on down to Pennsylvania Avenue, just off Route 29, to get our best deal ever on a brand new Tesla.
I want to make a good deal here. They have one, which is $35,000, which is pretty low.
Get a Model 1 with a different panel and everything's computer.
This is a different panel than I've had. Everything's computer.
So don't waste your time going to those other Tesla dealerships with riots and flaming cyber trucks. You gotta come down to White House Tesla Auto Mall.
I love Tesla.
You gotta come down to White House Tesla Auto Mall.
This is really amazing.
Tesla. There you have it, guys. There you have it. Everything is computer. So with that being said, thank you very much for watching today's video. Hopefully you guys liked it. If you did, consider dropping a like. Consider also subscribing to the channel. We do these videos every Monday through Friday after the close to help you guys as best as possible navigate this current market landscape. And also, if you have any questions, please feel free to leave them down below and I'll get back to you as soon as tonight, especially in this market environment. I want to answer your guys' questions as fast as humanly possible. And in the event that you also wanted to trade with other members or trade with myself as well, and have a group of like-minded people who are also big fans of buying the dip and a trading community where we make the most of any and all market conditions, well, the link to my Discord is down below. You get access to all my live trades, which are a bunch of wheel trades, call options, put options, call debit spreads, put credit spreads, long portfolio buys, especially nowadays. You want access to all those. These are all of my trades since the inception of the Discord, always very transparent with the wins, which are the green check marks, and the losses, which are these little red circles right there. Always transparent with all of them for you guys on the channel. You get access to all those trades, tons of different strategies, whether you have a small account, medium account, a large account as well. Additionally, we also do private morning live streams every morning where I trade live with you guys and answer all of your questions on your stocks, your options, your long-term portfolios. If you cannot attend, those live streams are all recorded. And you can also ask me all of your questions in our chat rooms all throughout the day. And I'm usually very fast to answer as well. I do private videos where I show you guys more in detail about technical analysis, advanced trading strategies, whether to the long side, to the short side, long-term portfolio building, how to grow small accounts into large accounts over time as well, with consistency and discipline in terms of some more advanced trading strategies. Members have been finding tremendous value in those videos as well. If any of that interests you, the link to the Discord is down below. And if not, well, I guess I'll see you guys back on the channel. Thank you so much for watching as always. Hopefully you guys are doing well and just stay focused, stay disciplined, and stay buying only the highest quality companies in the market right now, because for the most part, they will be the first to recover after this downturning spiral that we're seeing right now. I'll see you guys in tomorrow's video. That's it for me, and peace.